The ICT Turtle Soup strategy framework is one of the most misunderstood concepts in liquidity trading. Many traders assume that every liquidity sweep is a reversal signal, but in reality, some sweeps are designed to continue the trend, while others are engineered to trap breakout traders at major range extremes before the market reverses. In this video, you will learn the two ICT Turtle Soup frameworks we use here at Lucro, how to identify internal and external liquidity sweeps correctly, how to distinguish continuation setups from reversal setups, and how professional traders use market structure shifts, change of character, and liquidity engineering to build high-probability entries with precise risk management. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Let us begin. Here at Lucro, we have refined the ICT Turtle Soup framework into two liquidity models based on the type of liquidity being targeted by the market. The first model focuses on internal liquidity sweeps, where price temporarily sweeps short-term liquidity within a broader range before the main trend resumes. This variation is commonly used as a continuation setup. The second model focuses on external liquidity sweeps, where price attacks a major range extreme, takes external liquidity, and then fails to continue beyond that level. This variation is commonly used as a reversal setup back into the range. The key distinction between these two frameworks is understanding whether the market is targeting internal or external liquidity. Now, let us explain the ICT Turtle Soup setup within the context of an internal liquidity sweep in a bullish scenario. This setup appears when the market is already trending in one direction. Instead of reversing the entire range, price forms a temporary pullback, sweeps internal sell-side liquidity during that retracement, creates a fake change of character or fake market structure shift, and then resumes the main bullish trend. In this context, the Turtle Soup setup becomes a continuation entry rather than a full reversal, as shown in the chart example. Here, we are not looking for a random liquidity sweep. We are looking for a turtle soup condition forming within an internal range liquidity sweep context. This means price is still trading inside a broader range structure, but temporarily trades below an important internal low before reclaiming the range. The key idea is that the sweep itself is not the entry signal. The sweep only confirms that liquidity resting below the lows has been taken. What matters next is whether price fails to continue lower after the sweep and starts showing signs of bullish reversal on the lower time frame, creating a bullish lower time frame change of character or market structure shift. After that, within our framework, we apply a Fibonacci retracement to the impulsive move and place a buy order at the 50% retracement level. The stop loss is placed below the structure low, while the targets are divided into two levels. The first target is positioned at a 1-to-1 risk-to-reward ratio, and the second target aims for the most recent higher high on the higher time frame. The same logic applies to the bearish scenario, with all conditions inverted. Now, let us go to the chart, put everything together, and walk through how to identify the ICT Turtle Soup setup within the context of an internal liquidity sweep in a bullish scenario, step by step. On a bullish scenario, and within an internal range liquidity sweep context. First, start on a higher time frame, in this case, the 1 hour. In the bullish scenario, your focus is sell-side liquidity because that is where long stops tend to rest, below clear lows. Mark the most obvious levels, such as recent swing lows, previous day low, or previous week low. Then, once those liquidity areas are marked, wait for price to sweep that sell-side liquidity and close back above the level, returning inside the range. In many cases, this will appear as a candle that trades below the low and then closes back within the range, signaling a failed breakdown. However, in fast market conditions, this return can happen quickly and without much consolidation. After that, move down to your lower time frame, in this case the 5-minute. This is the time frame you will use for execution, not for prediction. Here you wait for a bullish market structure shift or a bullish change of character, meaning price starts to break above a key lower time frame swing high after the sweep, showing that bearish control is weakening. Here at Lucro, we prefer to apply a Fibonacci retracement after the market structure shift occurs. Keep adjusting the retracement as price develops, and place a pending entry order at the 50% retracement level, targeting the nearest higher time frame buy-side liquidity. The same logic applies to the bearish scenario, with everything inverted. Now, the framework we just covered can be refined even further by incorporating fair value gaps into the execution process. Instead of relying only on the liquidity sweep and structural shift, we can use fair value gaps to identify more precise entry locations aligned with the underlying liquidity narrative. By combining market direction, liquidity manipulation, and imbalance-based execution, the setup evolves from a simple liquidity sweep into a more structured institutional framework. A high-probability bullish turtle soup setup occurs when price raids liquidity below a recent swing low, while remaining positioned above a bullish fair value gap. In this case, the market sweeps sell-side liquidity, triggering stops from retail traders, but holds above a key demand imbalance. Similarly, a bearish turtle soup forms when price raids liquidity above a recent swing high while resting below a bearish fair value gap, signaling that buy-side liquidity has been collected before a potential move lower. Now, how do we approach execution? In this example, we clearly see an established uptrend, which means we are only interested in buying opportunities. The first reaction might be to place a buy limit directly at the visible demand zone. On the surface, this area appears to be a strong entry point. However, as smart money traders, we understand that this is exactly where many retail participants will enter long and place their stop losses just below the structure. This creates a strong probability of manipulation at that level, as the market often dips below the obvious demand zone to target sell-side liquidity before continuing higher. If you analyze the left side of the chart, you can also identify a bullish fair value gap that acts as a more refined demand zone. This imbalance provides a cleaner and more strategic location for entering a long position, aligned with liquidity logic rather than emotional entries. To properly trade the turtle soup setup, in a bullish scenario, we wait for price to sweep the liquidity below the swing low and then observe signs of rejection near the fair value gap. The key is patience. The liquidity raid below the low is designed to trigger sell-side stops and trap breakout sellers. Once price returns back inside the prior range after the raid, we can execute a buy position with our stop loss placed safely below the manipulated zone. From there, we target the next significant level ahead of price, typically a liquidity pool or structural high aligned with the prevailing trend. Now, in the bearish scenario, the same logic applies but in reverse. We wait for price to sweep liquidity above a recent swing high, and then watch for rejection near a bearish fair value gap. This move above the high often traps breakout buyers and collects buy-side liquidity. Once price drops back inside the prior range, we can open a sell position with our stop loss placed safely above the manipulated zone. The target then becomes the next important level below price, usually a sell-side liquidity pool or structural low aligned with the broader bearish direction. In this example, fair value gaps simply act as an additional execution layer within the ICT Turtle Soup framework. While the core logic still comes from liquidity sweeps and market structure shifts, fair value gaps allow us to refine entries with greater precision and better risk management during continuation conditions. The important takeaway is that the ICT Turtle Soup framework is not limited to a single execution model. Depending on market conditions, liquidity context, and overall structure, the setup can be adapted using different tools such as fair value gaps, structural confirmations, or retracement-based entries, while still following the same underlying liquidity principles. Now, let us explain the ICT Turtle Soup setup within the context of an external liquidity sweep in a bullish scenario. This setup appears when the market is already trending bullish and approaches an important external range high. Instead of continuing higher after the breakout, price sweeps external buy-side liquidity above the range extreme, triggers breakout traders and stop losses, and then quickly fails back below the level. In this context, the ICT Turtle Soup setup becomes a reversal entry rather than a continuation setup, as shown in the chart example. Here, we are not looking for a random liquidity sweep. We are looking for a turtle soup condition forming at an external range extreme. This means price temporarily trades above a major high, takes the liquidity resting above the range, and then reclaims the previous structure after failing to sustain the breakout. The key idea is that the sweep itself is not the entry signal. The sweep only confirms that external liquidity resting above the highs has been taken. What matters next is whether price fails to continue higher after the sweep and starts showing signs of bearish reversal on the lower time frame, creating a bearish lower time frame change of character or market structure shift. After that, within our framework, we apply a Fibonacci retracement to the impulsive move and place a sell order at the 50% retracement level. The stop loss is placed above the structure high, while the targets are divided into two levels. The first target is positioned at a 1-to-1 risk-to-reward ratio, and the second target aims for the most recent lower low on the higher time frame. The same logic applies to the bearish scenario, with all conditions inverted. In an ICT Turtle Soup setup, within the context of an external liquidity sweep in a bullish scenario, the setup forms when a trending market temporarily fails after sweeping an important range extreme. First, start on a higher time frame, in this case the 1 hour, and identify a clear bullish structure with higher highs and higher lows. In this scenario, your focus is buy-side liquidity resting above the recent highs, where short stops and breakout entries tend to accumulate. Price often makes a shallow pullback, sometimes not even forming a clear higher low, and then pushes above the previous high. This move sweeps buy-side liquidity above the high, triggering stops and attracting late breakout buyers. Then, instead of continuing higher, price fails to hold above the high and starts to reverse, signaling that the breakout was false and that liquidity has been taken. After that, move down to your lower time frame, in this case, the 5-minute. This is the time frame you will use for execution, not for prediction. Here, you wait for a bearish market structure shift or a bearish change of character on the lower time frame. This occurs when price breaks below a key internal swing low after the sweep, showing that bullish control is weakening and that price is no longer accepting higher levels. Here, at Lucro, we prefer to apply a Fibonacci retracement after the market structure shift occurs. Keep adjusting the retracement as price develops, and place a pending entry order at the 50% retracement level, targeting the nearest higher time frame sell-side liquidity. The same external range logic applies in a bearish market as well, with everything inverted. So, whether the market is using internal liquidity sweeps for continuation or external liquidity sweeps for reversal, the core principle behind the ICT Turtle Soup framework remains the same. Understanding how liquidity is engineered before the real move develops, when combined with proper market structure analysis, disciplined execution, and strong risk management, this framework becomes a structured and repeatable approach for identifying high-probability trading opportunities across different market conditions. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the Lucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.